Hey option traders, for today's trade we are looking at a covered call strategy on Dow Jones stock IBM. The stock is one of the top yielding stocks in the Dow and is in a nice uptrend showing improved relative strength. So looking at IBM on MarketSmith, shares have been on a big run since mid-October and are currently trading well above support at the 50-day and 200-day moving averages. While the run has occurred in strong volume, the recent pullback has occurred in slightly lighter volume, which is exactly what you want to see. The stock shows a healthy dividend yield of 4.5% at this time. Investors searching for yield can further enhance it on IBM by using an option strategy known as covered calls. Before we place this trade, though, let's review the covered call strategy in a bit more detail. A covered call is a simple strategy designed to collect income while also defining a predetermined exit price at which you'd sell the underlying stock. Say you buy 100 shares of a stock. Covered calls can allow you to lower the cost basis of the long position via selling call options against your position. To refresh everyone, a call option is a contract between a buyer and a seller to purchase a specific stock at an agreed upon price known as the strike price up until a defined expiration date. Remember that with options, there are two types of options. You have calls and puts. And with both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy it long or sell it short. To set up a covered call, you'd simply need to first buy shares of the underlying stock, then become the seller of call options on that stock, collecting income to offset your cost basis. As the seller of the call option, you'd be obligated to hand over your shares to the call buyer at the agreed upon price or the strike price, if shares trade above this price at the expiration date. In exchange for this, the buyer of the contract pays you a premium. Any appreciation in the stock above that strike price represents profit for the call buyer. But if the stock instead declines in value, the buyer would have no reason to exercise the right to buy it for a higher cost. In this case, they'd likely just allow the contract to expire and lose the premium paid. Depending on the option, you could have a number of expiration dates and strike prices to choose from. This, incidentally, is one of the strengths of options. Options provide choices, and investors can analyze a variety of criteria to determine which of those choices best fit their needs. Investors must understand that time is a double-edged sword, especially for the buyer. Option contracts decrease in value at an accelerating rate as they get closer to their expiration date. If you're considering putting on a covered call in a given stock, you should first ask yourself, do I believe that the stock will trade in a neutral to bullish direction? And am I willing to own this stock even if the price falls a little? If the answer is yes to both of these, then it may be okay for you to proceed in this trade. Covered call writing is not simply a buy and hold strategy. It involves thinking ahead about appropriate action and possible future scenarios. For example, if the stock price declines, where will you sell and take a loss? The covered call seller bears the risk of any price declines in the underlying stock. If you purchase the stock for, say, $43 a share, but collected $1 in premium from selling a call option, you've reduced your break-even point on the stock to $42 a share. If it continues to fall below that price, it may be better to close out the trade early for a loss. So now that you have a better idea of covered calls, let's take a look at my trading platform and set up a real-life trade in IBM. So to set up this trade, first make sure you are looking at IBM, ticker symbol IBM. And if you're on Thinkorswim, you're going to select covered call here in the spread type box. And make sure you are looking at the January 20th expiration date. You'll find your strike prices down here in the middle. And we're going to look at the 150 strike price right here. But we want to look at this side of the screen, which has the prices for call options. So click on this side of the screen to set up the trade. So to recap, we are looking at selling one IBM call with a 150 strike expiring January 20th, while simultaneously buying 100 shares of IBM stock. For this trade, a January expiring 150 call option can currently be sold for around $3.40. This would generate $340 in premium per contract and increase the annualized yield of the stock by 17%. IBM currently pays around $6.60 in annual dividends, so generating another $3.40 from covered call writing in just 1.5 months is quite attractive. The $3.40 premium received also gives a small buffer on the downside of roughly 2.3%. That means IBM could trade 2.3% lower between now and January 20th, and the covered call trade would still break even. The total capital at risk in the trade would be $14,309, and if IBM stock went to zero, that is how much the trade would lose. But as reasonable and careful traders, we would be sure to close the trade long before the stock ever dropped to zero. If shares close above 150 on the expiration date, the underlying stock will be called away at 150, leaving you with a total profit of $340 in premium, plus any gains on the stock from the price at which you purchased it initially. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.